Welcome to Dual Edge Research, where we provide disciplined, data-driven strategies designed to help investors succeed across multiple markets. Dual Edge Research publishes two powerful newsletters that work great individually and even better together. The Bull Strangle newsletter focuses on stocks and options, combining stock ownership with premium selling strategies to generate consistent income and market-beating returns. The Smart Spreads newsletter specializes in seasonal commodity futures spreads, offering a diversified approach with low correlation to equities. Together, they deliver a complete investment perspective, one focused on income, the other on diversification, all under one simple subscription. Two powerful strategies, one disciplined source, Dual Edge Research. This video will focus on the Smart Spreads newsletter, which provides weekly seasonal spread setups, each with predefined entry and exit dates, historical performance metrics, and margin-efficient trade structures. Before we dive into seasonality, here's what to expect from the Smart Spreads strategy. Each trade is an intra-commodity or calendar spread, buying one month and selling another within the same market. This structure naturally reduces risk, volatility, and margin requirements. Trades typically last 12 days to several months, focusing on swing and position trading, not day trading. It's a slow and steady approach built on discipline, data, and consistency. Smart Spreads emphasizes risk control, limiting exposure to under 2% per market and under 3% per group, while spreading trades across multiple sectors. The goal is to profit on about 65% of trades with a win-to-loss ratio near 1.4 to 1, producing steady compounding growth over time. In short, Smart Spreads is balanced, diversified, and data-driven, a methodical strategy built for consistency over speculation. Now back to the main topic. The Smart Spread strategy is built on four foundational elements: commodities, futures contracts, seasonality, and spread trading. Together, these components create a structured, data-driven framework designed to identify repeatable opportunities in the commodity markets. This video will focus on commodities and futures contracts. Seasonality and spread trading are discussed in more detail in the video Seasonality, found on the Dual Edge Research YouTube channel. Commodities are everywhere, in the food we eat, the fuel we use, and the products we depend on every day. But have you ever wondered how producers, consumers, and investors manage the constant ups and downs in commodity prices? In this video, we'll take a closer look at what commodities are, how futures contracts work, and who actually trades them, from farmers and manufacturers to professional investors. You'll see how these markets connect the real economy to the financial world, and why understanding them is so important. Let's get started. Commodities are the raw materials that power the global economy and shape everyday life. They include grains like corn and soybeans, energy markets such as crude oil and natural gas, meats like cattle and hogs, softs including coffee, cocoa, and sugar, and metals such as gold, silver, and copper. Each plays a vital role in global supply and demand, and Smart Spreads tracks them all to uncover powerful seasonal trading opportunities. Now let's turn our attention to futures. A futures contract is a legally binding agreement between two parties to buy or sell a specific commodity, asset, or financial instrument at a predetermined price on a set date in the future. Futures contracts are standardized and traded on regulated exchanges, which ensures transparency and liquidity. They allow producers and consumers to lock in prices ahead of time to manage risk, and they give investors the ability to speculate on price movements without owning the underlying commodity. In short, futures contracts are a vital tool for price discovery, risk management, and market efficiency across the global economy. Who buys and sells futures? The short answer is hedgers and speculators. Hedgers can be producers who want to lock in a selling price today for what they'll deliver later. For example, in the spring, a corn farmer commits real money, fertilizer, fuel, seed, and labor to grow a crop. Adding up those costs, the farmer sets a price he needs to receive to make a profit. He worries that by harvest time, corn prices could drop below that target and fail to cover costs. To reduce that risk, he sells a futures contract, locking in a selling price for part or all of his expected crop. If prices fall by harvest, the lower cash price is offset by a gain on the futures position, protecting his margin. If prices rise instead, he gives up some upside on the hedge, but benefits from a higher cash price on the crop. That's how producers use futures, not to speculate, but to stabilize revenue and manage price risk. Hedgers aren't just producers, they can also be consumers who want to lock in the purchase price of a commodity they'll need later. Let's look at an example. A food manufacturer plans to buy corn in the future. Since corn is a major ingredient in their products, its cost directly affects their profit margins. The manufacturer sets a budget for production costs and determines the price they can afford to pay for corn while still meeting profit goals. But there's a problem. Corn prices could rise before they make their purchase, squeezing their margins and threatening profitability. To protect against that risk, the manufacturer buys a futures contract. This locks in the price of corn today for delivery at a later date. If corn prices do rise, their higher cost in the cash market is offset by a gain from the futures position, helping to stabilize costs and protect profits. That's how consumers use the futures market to manage price risk and maintain predictable costs for the raw materials they depend on. While producers and consumers use futures to hedge risk, speculators, like smart spreads, trade with the goal of profiting from price changes. Here's how that process works. First, smart spreads analyzes thousands of commodity spread combinations to identify historical patterns with strong profit potential. Second, current market prices are compared to historical averages to confirm that the spread is trading within normal seasonal or historical ranges. Third, based on over 15 years of data, a specific date is chosen to open the trade, the point where the historical edge is strongest. Fourth, once the trade is open, prices are monitored daily to determine whether adjustments or profit-taking are needed. And finally, the position is closed on a predetermined date, again based on those same long-term historical tendencies. This disciplined, data-driven process allows smart spreads to participate in futures markets as a speculator, capturing opportunities while maintaining strict timing, structure, and risk management. Hedgers and speculators both trade futures contracts, but for very different reasons. Hedgers use futures as a form of insurance, a way to protect against unforeseen losses from price changes. They're not trying to make a profit on the contract itself. Instead, their goal is to stabilize revenue or costs. Hedgers are typically producers or consumers who intend to deliver or take delivery of the commodity in the future. Speculators, on the other hand, take on business risk in pursuit of profit. They enter trades with the sole intent of making a gain from price movement, not to buy or sell the physical commodity. And before the contract reaches its final trading day, speculators close out their positions, realizing either a profit or a loss. In short, hedgers manage risk, while speculators create liquidity and opportunity, two essential forces that keep the futures markets balanced and efficient. Looking for consistent profits in both stocks and commodities? Now you can get two powerful newsletters for one simple price. For stocks and options, the Bull Strangle newsletter shows you how to combine stock ownership with dual option selling, a disciplined strategy that has consistently outperformed the S&P 500. For commodity futures, the Smart Spreads newsletter focuses on seasonal commodity spreads, a proven, low-correlation approach that thrives in all types of markets. Each newsletter is designed to deliver consistent income on its own. But when used together, they create a complete, diversified trading approach that works in any market environment. Subscriptions start at just $49 a month, with deep discounts on 3-month, 6-month, and annual plans. And right now, for a limited time, your first month is only $1. There's no long-term commitment. Cancel anytime. So don't wait. Visit bullstrangle.com/products. That's bullstrangle.com/products. And start trading smarter today with the Bull Strangle and Smart Spreads newsletters.